Imagine spending decades building a pension, only for your family to lose almost everything when you die. And from next April, that could become a very real concern for some UK families. New calculations suggest inherited pensions could, in certain circumstances, face a combined tax burden as high as **91%. But here's the part many people may not realize: this isn't simply about inheritance tax. There is a tax blind spot that could cause bereaved families to lose hundreds of thousands of pounds more than they expected. And if you have a pension that you intend to leave to your children or other family members, there's something you may need to understand before the new rules take effect. So why could a pension suddenly become so heavily taxed? The answer begins with a major change coming from April. Under the planned rules, unused pension funds will be brought into the estate for inheritance tax purposes when someone dies. That means a pension that many people have traditionally viewed as something they could pass on efficiently may become part of the inheritance tax calculation. And this creates a problem. Because inheritance tax isn't necessarily the only tax your beneficiaries could face. Depending on the age at which you die, the size of the pension, the income of the person receiving it, and other circumstances, your beneficiaries could potentially face multiple layers of taxation. And that is where the headline figure of 91% comes from. Think about what that means. Suppose someone has spent years building a substantial pension and intends to leave a significant amount to their family. If the pension is caught by inheritance tax and the beneficiary then faces income tax when accessing the inherited pension, the amount ultimately reaching the family could be dramatically reduced. In the worst-case scenarios highlighted by the calculations, the combined tax impact could consume the vast majority of the pension. Up to 91%. Now, that doesn't mean every pension will suddenly be taxed at 91%. That distinction is extremely important. The 91% figure represents a particular combination of taxes and circumstances. But the underlying warning is much broader. People who have spent years planning their retirement may not have considered what happens to their pension after death under the new system. And that could create a very expensive surprise for their families. Here's another reason this matters. Pensions have historically been one of the most powerful tools for passing wealth down generations. Many people deliberately leave their pension untouched during retirement and use other assets first. Why? Because depending on the circumstances, pension savings can be an efficient way of passing wealth to children. But once the rules change, the calculation becomes much more complicated. The question is no longer simply, how much is in my pension? It becomes, how much will my family actually receive after every relevant tax has been taken into account? And that is a very different question. Financial services firm NFU Mutual has warned that the impact could be particularly painful for families with larger pension pots. Its calculations suggest some families could lose hundreds of thousands of pounds more from their inheritance because of the interaction between the new inheritance tax rules and income tax. So what can you actually do? The first step is not to panic. And certainly don't make a major pension decision simply because you've seen a 91% headline. Instead, work out exactly how the new rules could affect your own circumstances. Look at the value of your pension. Look at your other assets. Consider who would inherit your pension. And importantly, consider the potential tax position of the person receiving it. Because the same pension pot could produce very different outcomes depending on the family's circumstances. It may also be worth reviewing your wider estate planning strategy with a regulated financial advisor or qualified tax professional. The biggest mistake could be assuming that the pension plan you made years ago will automatically remain the best strategy after the rules change. Because from April, the tax treatment surrounding inherited pensions is changing. And for some families, the difference could be enormous. A pension worth hundreds of thousands of pounds may look like a substantial inheritance on paper. But the amount your family actually receives could be dramatically smaller. So if you're approaching retirement, already retired, or have built a sizable pension specifically to leave something behind for your children, don't wait until the new rules arrive to find out what happens. Because the most important number isn't the balance showing on your pension statement. It's the amount your family could actually keep. And with a potential tax hit reaching as high as 91% in the most extreme scenarios, that number is one you may want to calculate now, rather than leave your family to discover it later.